A focus back today on finances and what to do in this environment when it comes to the property market. Gavin Martin from Cornerstone Wealth is back with us. Gavin, welcome back to 2020.
Thanks, Neil. Great to be with you.
Gavin, last time we were talking, we talked about a low interest rate environment and whether it was worthwhile being involved in a volatile stock market where things go up and things go down. Let's have a talk today about the property market in Australia. A lower interest rate environment, things are likely to remain that way for a little while yet. What does that mean for people who potentially are property investors?
For property investors, lower interest rates generally means that you can either borrow more or you're going to get a better return in your investment because you're paying less interest out and you're able to still get the same level of rental return. So you're actually improving the performance of your investment. Actually, this is what happened about 20 years ago when interest rates halved and the cost of borrowing reduced significantly and people could borrow twice as much. So I think a lot of the reason for the 20-year sort of rally in property prices or significant growth in property prices over that period is the halving of interest rates because people could borrow twice as much, and then when you're at an auction and two people have got twice as much money, that then bids the price up on property. But as we see lower interest rate environments now, I guess the question is, how long will it take for the property cycle to build again? And that's the unanswerable question. How long will that take? We can't really say, but it'll be interesting to see.
Yes, with volatile global economies, talking about Europe and the United States with their own debt issues, that has an impact here in Australia. And really, I guess it's a question of confidence as to when that might return in the Australian market, because while we keep hearing good news one day, bad news the next, it doesn't do much for confidence, does it?
No, it doesn't. There's still so much uncertainty out there in the economy. We feel like we've got through a significant hurdles with the European situation seeming like it's under control, and the US seeming like its debt problems sorted with the fiscal cliff. But I think there are a couple major things as the tax breaks in the US start to cease, and the other major issue with the US is that interest rates could rise over there as well. They've set very low, I think close to zero at the moment. So if interest rates rise in the US, then that can have flow-on effects, and that's where it can impact us in Australia as well and see interest rates go back up. So I guess be wary if in the current low interest rate environment, if you're going to either extend your property investment portfolio or buy your first home, don't just factor in the current interest rates, but factor in 2 or 3% more than what they currently are, because as the federal budget comes back to surplus and they no longer need to increase taxes and pull that money out of the economy, you'll see interest rates potentially go back up, and you need to be able to afford the loan at that higher interest rate.
Gavin, a lot of first home buyers are reluctant even at this point to get into the market, but that saving of a significant deposit is really important, isn't it, when you're thinking about that first home?
Yeah, so saving at least a 20% deposit is ideal because you can then avoid mortgage insurance, and it does provide that buffer that if the value of your property did go down by 20%, you've still got, and you had to sell the property, you haven't got an overhanging debt that you still need to deal with. So the bigger the deposit, the better it is. I've got a spreadsheet that actually shows what an additional payment early on in the mortgage saves you in interest. So early on in a 30-year mortgage, if you make an additional payment of say $50, that's going to save you about 4 times as much in interest. So it might save you $200 in interest over the term of that loan. And it works the same with a deposit. So if you've got a larger deposit, the less interest you're going to pay out over the term of the loan as well.
Generally speaking, Gavin, your outlook for 2013, the year ahead of us, when it comes to real estate, any thoughts on where things might go? Obviously, lower interest rate environment. First-time buyers have been reluctant to to have any sort of surge, even though interest rates have been lower. What sort of outlook might you look forward to for the coming year?
Oh, my expectation would be, and it's it's a guess as much as anything. We can't predict the future, but my expectation would be just a steady, slow growth as we, I guess, see the if the low interest rates are able to be maintained, and there's no massive implications from overseas economies, then I would expect that property prices continue to grow at a reasonable rate and not go down any further. But thinking about that, we can't predict the future, so you've just got to make your investment decisions based on your current circumstances, and don't get too caught up on trying to predict the future or time it, because that's really difficult to do. As long as you're buying a reasonable property and you've not got too much debt, then you're not stretching your family budget, then I think it's a reasonable thing to consider those types of investments.
Well, Gavin, always good advice. Don't stretch too far, but being a generally favourable environment in which we should be confident with low interest rates and property prices down a little. Gavin, I'll point people to your website at www.cornerstonewealth.com.au. Gavin Martin, always good getting your insights. Thanks for being with us again today on 2020.
Thank you. Always good to chat with you, Neil.